Thank you for inviting me to present in this halftime session. My name is Padma Kadiyala. My day job is as a professor of finance at Pace University. I'm also the founder of Value Financials, which is a trading software. I'm in the process of developing it, and I'm hoping that I can start offering it to the investing public at the beginning of fall 2022, which is the fall of this year. This is going to be a very interactive session, so please feel free to jump in, and I will prompt you with questions, and feel free to make suggestions, offer answers, solutions. As they always say, there are no bad questions, bad answers. So every answer is a good answer. The topic is making capital investment decisions. So the first 4 slides of my presentation today, I'm going to talk about what do those words capital investment mean? What does it look like when you see an expenditure? How do you recognize it as a capital expenditure? And then we'll move on to how do you evaluate a capital expenditure?
I think what it pointed to the computer. Is that allowed?
No, it should go.
There. So here are 2 pictures. One is a purse, a Gucci purse, in the upper left-hand corner.
Is that yours?
And in the lower right-hand corner, there is a painting by Van Gogh. How would we think about these 2, let's call it expenses? Forget that the scales are extremely different. The painting costs about 30 million, the last estimate. But if you had cash burning through your pocket and you wanted to spend on one of these 2 things, how would you think of the Gucci purse and how would you think of the painting? What is different about these 2? What is similar about these 2? Any answers?
They're both expensive.
Yes, they're both expensive, which is why we have to give it some thought. We can't just rush out and buy it.
Yeah.
Well, I would think the painting would appreciate faster or more than the purse, better resell.
Because well, I guess you could make copies of both of them.
Oh my God.
Is one
How is
for
that
one?
crypto going, Felicia?
Is one for like personal use and one is more general use? Maybe.
Very good answer so far. So all of them excellent answers. And exactly, I think both are expensive, so you have to give it a lot of thought and consideration. The Gucci purse perhaps doesn't appreciate. There may be vintage Gucci purses that do, but more likely if you're using it regularly, it's going to suffer from wear and tear. And if you go to sell it 10 years down the road, you may not recover your initial cost. On the other hand, the painting, if you take good care of it, don't expose it to sunlight and so on, in 10 years, it could appreciate quite a bit. So one is an investment that's appreciating, the other one is unlikely to appreciate and suffers from wear and tear.
Yep, there we go.
Okay, so we agreed that the painting can appreciate. So let's now introduce another investment in the upper left-hand corner, which is, let us say, it's residence that you would like to rent out. So it's a rental investment, rental housing. How would you now think about these 2 investments?
Well, the house you get monthly back, money back on. So there's income. You don't get income from a painting hanging on the wall.
Perfect. That's exactly the answer I was looking for. Both are investments. Both investments appreciate. Just as the painting appreciates, hopefully the housing appreciates as well. However, as Jen said, the housing provides cash flows, regular cash flows, monthly rentals, whereas the artwork does not generate any income So the artwork is an investment, but we can add another adjective to the word investment and call it a speculative investment, right? Because we're buying it with the expectation that the price will go up in the future. With the residential housing, with the residential asset, you expect that it will go up in value in the future, but you also expect to generate investment income during the time that you're holding on to it. And finally, in a business context, let's say you're presented with these two, your accountant comes up to you and says, we really need a laptop, versus, oh, we need to, acquire this commercial space, and so that we can, house our administrative staff in this building. How would you now think of these two expenditures? Well, the laptop is considered an operating expense versus the commercial property, which would be considered a capital expenditure. Let's look at what the differences are between these two types of expenditures. So the CapEx refers to capital expenditure, and the OpEx refers to operating expense. Okay. They differ along 5 dimensions. The first is the purpose. CapEx is an investment in assets. So what is an asset? An asset is anything that's usually a long-term investment. It's purchased with a useful life beyond the current year. Whereas the operating expense is an ongoing cost to support day-to-day business. So if you need something to support your day-to-day business and you have to go out and buy it, it would be considered an operating expense. Versus you buy something and it's going to sit on your property and it's going to help you run your business for a long term, then that would be a capital expenditure. When do you have to pay for these two expenses? For the CapEx, you spend the amount upfront. So there's a lump sum amount that you have to invest upfront. For the operating expense, it's a recurring monthly or annual expenditure. How would your accountant account for these two expenses? For the CapEx, it would be over a 3 to 20 year lifespan while the asset depreciates. And in the case of the operating expense, it is in the current month or year. How is this, each of these expenses, how are they listed on your financial statements? Well, the CapEx shows up on the asset side of your balance sheet under fixed assets or property and equipment, whereas the operating expense shows up on your income statement as an operating cost. How about the tax treatment? The tax treatment of CapEx, it is deducted over time as asset depreciates, so you can only take the depreciation, not the entire expenditure on the investment upfront. You can only take the depreciation as an expense every year, versus the operating expense, it's deducted in the current tax year. Okay. So here I'd like to give you a small anecdote. There was a utility company that was forecasting a very stormy summer. So they went to the board and said, well, we'd like to spend some money putting up utility poles that are wider than what we normally put in. And we also want to space them closer together so that if the tree falls on these poles, then it doesn't bring down the wires. So one of the board members said, why not just cut down the trees? So this CEO responded, well, if you cut down the trees, it would be an operating expense and it would hurt our earnings and that wouldn't go down very well with our shareholders. However, if we put in these electric poles, we could call it a capital expenditure and would look good on our balance sheet. So,
So that's how the electric companies work. Next time my power goes out, I know,
So let's think of a project that is an example of a capital expenditure. Let's say that you're thinking of installing solar power, okay? Because you're sick of these utility companies and your power going out because of a storm and you would like to have your own little power plant. Okay, so this is what it would look like. You would fix solar panels to your roof. Okay, what are the kind of things that you would have to consider as you're evaluating whether or not to install solar power?
Any tax credits, deductions?
Excellent. Tax credits.
Lifespan of the,
Tax credit lifespan of the solar
yeah, the
panels.
solar. Mhm.
Mhm.
How your monthly bills would change, so like your cash flow.
Monthly bills,
The cost of installation?
cost of installation. Very nice. Any other considerations? Well, those are exactly it. So all of these that we've talked about, the tax credit lifespan, monthly bills, cost of installation, are collectively called incremental cash flows. So the important thing when you're evaluating any capital expenditure is to think in terms of cash flows, okay? Not accounting earnings. What's the difference between cash flows and accounting earnings? Well, cash flow is the actual cash flow into and out of your bank account. Unlike accounting earnings, which includes all kinds of things like depreciation, which is not actual flow of cash. It also depends on how you account for inventory, and depends on how you account for your taxes and so on. So accounting earnings is sort of fictitious earnings, versus cash flows, which is the actual flow of cash into and out of your bank account. Sunk costs. When there are sunk costs that you incur, meaning you've already spent that money, those kinds of costs should not be included in the analysis. Why not? Because you've already spent it. So it has no bearing on the profitability of the project. Incremental, the word incremental is in italics to indicate that it is the cash flows with the project versus the cash flows without the project. So what do I mean by that? Well, if there is an expense that you would incur no matter what, then you should not include it in the analysis because it's not dependent on whether or not you take this project. So only cash flows that you're going to incur or you're going to receive incremental to what you already have should come into your analysis. Opportunity cost matters. So in the real world, there are opportunity costs. What is the definition of opportunity cost? It is the next best use of any asset that you have. So ignoring opportunity costs can lead to very costly investment decisions. Side effects like cannibalism and erosion matter. So you see a Starbucks pop up on every block and you wonder what were what was management thinking? Because when you have too many stores next door to each other, then one store can cannibalize the other or vice versa, or it could happen that over time people stop going to these stores because they've oversaturated the market. So these are called side effects and they should be considered in any capital investment decision. The reason I'm spending time on these different types of cash flows that have to be considered is because a capital expenditure involves a lot of money. And it can be a very good decision or it can end up being a very bad decision. And nobody goes into these things thinking that they're making bad decisions, except that they may not have considered some of these issues. Are they looking at opportunity costs? Have they accounted for cannibalism? Have they included sunk costs wrongly and things like that? Taxes matter in the real world. We can't avoid taxes. So we want to be looking at after-tax cash flows. And finally, inflation matters. So in today's world,
It's like a dirty word.
in the past, I would say inflation and nobody would even think about it, but suddenly now everybody cares about inflation. So I'd like to walk you through a project.
So I'm going to go to Excel.
Yeah, would you please? Thank you. If you double click, yeah, there we go. So the requirement for a solar power plant in a business maybe is for a 10 kilowatt hour system, which is going to generate anywhere between 29 to 46 kilowatt hours per day, which translates to 870 kilowatt hours per month at the low end. The reason that there is a range is because of how much sunlight you get and so on. The current requirement for a 2,000 square foot home or a 2,000 square foot business, it needs 1,000 kilowatt hours per month. And the cost of electricity in Connecticut, the generation cost that we have to pay when we receive the bill is 25.5 cents per kilowatt hour. The cost of installing solar panels varies from state to state. And in Connecticut right now, it's running at $2.86 per watt. I've included the cost of a personal loan, but we'll talk about it a little bit later. So now, how would you evaluate whether it is worthwhile to invest in the solar power plant or not? Well, I have a table. The first column in this table is the year. The second column is the initial cost. So recall from that table that was looking at the difference between CapEx and OpEx. For a CapEx, there's a lump sum upfront investment. So there's an initial cost. The initial cost works out to be $28,600. And the way I arrived at that number, if you look at the formula bar, it's the cost per panel of 2.86 times the 10 kilowatts, and kilowatts is 1,000 watts. So I end up with an initial cost of 28,600. The negative sign in front of the 28,600 simply means that it's money out of our pocket. So it's cash outflow. It doesn't mean it's a loss. It's just a flow of cash out of our bank account. Now you mentioned the tax credit. There's a federal tax credit, which is 26% of the cost. So what is a tax credit? That means that you actually receive a credit from the IRS in that amount. So it's a cash inflow. So 26% of 28,600 is 7,436.
Is that deducted as a sum or is it deducted as like a tax deduction?
So it's not a deduction, it's a credit. So let us say at the end of the year, when you're filing for taxes, your taxable, the tax you owe before this credit is $1,000.
Right.
And you receive a credit for.
Oh, so it's a credit. Okay. So then they'd owe you 6,000
Yeah,
something.
Yeah,
Okay.
exactly.
Rarely happens.
Rarely.
Well, it's going to be phased out, but that's the incentive that the federal government is giving to homeowners to switch to renewable power. So the total investment works out to be the initial cost net of the tax credit, which works out to be a negative 21,164. The negative indicates that net of the tax credit, we have to spend 21,164 to get this project off the ground. You mentioned savings, monthly savings. So what are the savings? Well, we are expecting to be able to generate 870 kilowatt hours per month from the solar power plant. So per year, that works out to be 870 kilowatt hours times the 25.5 cents that we are being charged in the state of Connecticut, times 12, because this is on a monthly basis, times 12 gives us the amount on an annual basis. So the amount we save is 2,662.2. We can ignore the 0.2. And that's a plus because that's savings, that's a cash inflow. For now, let's assume we have to consider a base case scenario. So in this base case scenario, we are assuming no inflation. So there's no change in the cost of electricity in Connecticut. So our savings remain at 2,662.2. So the total works out to be 2,662.2 for 10 years. Now, somebody said, what is the lifespan of this equipment? Well, the lifespan, I'm told, is 15 to 20 years, but we can stop at 10 years because if, it's a reasonable time period. And generally, we would project these cash flows for up to 10 years, and beyond 10 years, it becomes quite speculative as to whether you can actually forecast the cash flows that far into the future. Okay. So now that we have our cash flows, let's stare at them for a moment. You are going to spend 21,164 upfront. That's money coming out of your bank account right away. And in exchange, you're going to receive $2,662 every year for the next 10 years. So is this a good investment or not? That's the key, right? That's the decision. That's the moment when you know whether you should go ahead and invest or not.
How much does it cost every month if you don't do this, just paying electricity?
So just plain electricity, the requirement is 1,000 kilowatt hours per month. So 1,000 kilowatt hours times 25.5 cents.
Okay.
So going back to the idea of incremental
Right.
cash flow.
Yeah.
So that's why I only include the savings.
Okay.
Right? The savings is what is relevant. What is incremental to this project? We need electricity no matter what. So what we're normally we would have paid is for 1,000 kilowatt hours, but 870 of that is coming from our solar power plant, and so that represents our savings. One way to evaluate such an investment is to calculate what is called a payback period, which is how fast can we recover our initial investment. In this case, it's easy to calculate the payback period. You simply take the initial investment and you divide that into the annual savings. And the payback period works out to be close to 8 years, 7.95 years. So it's going to take 8 years to pay back our initial investment.
Is there a scale that certain projects fall into like a certain payback year? Like what if it's a truck? What if it's a copy machine? What if it's this? Like how do you evaluate what's a good payback and not a good payback?
That's an excellent question.
Thank you.
So unfortunately, there is no theory that tells us what is a good payback. What happens is that businesses that have been around for a long time just develop a rule of thumb. So it's a rule of thumb that seems to have served them well in the past. So they think, okay, if that's what we've used in the past, we should continue to use that into the future. Generally, most people, most businesses, and most business owners are comfortable with a payback between 2 and 3 years, regardless of the type of investment. So I think in people's minds, there is a scaling going on. So if the investment is huge, they expect the savings to be huge as well, so that regardless of the scale of the investment, they hope that the payback would be between 2 and 3 years. Okay. So when you see a payback of 8 years, that might give you pause. And you might think, does it make sense to actually go ahead with this? Well, let's now think about the other things that we have ignored in this analysis. Go back to the slide. Is that? So what are the other considerations? Well, inflation, certainly. We ignored inflation earlier.
Let me get this show back.
Okay. Inflation may change the picture, and we'll look at it in a moment, how inflation will change our analysis. Interest costs. So I did have a slide on what the cost of a loan would be. So we didn't include it in our analysis, so we would have to incorporate it somehow. What if you're using your own savings? You're not relying on a bank loan, but you're taking money out of your bank account and using that to finance this investment. How should you consider that? Comparison across alternatives. Let us say you had geothermal power as an alternative. How would you evaluate solar power versus geothermal power? What about maintenance costs midway?
Big one. I was just thinking of solar. I keep hearing people putting solar on and getting squirrels under them.
Is that right?
Yeah, or they have to change their roof tiles or things like that.
It's a lot of unexpected.
Yeah.
Wow. So all of these projects are going to involve maintenance costs. So how would you incorporate all of these things? So it's a huge subject, which I don't have time to cover today. So
Is depreciation also something that would be coming up, the depreciation on the,
So for a residential investment, we're not allowed to depreciate the
Oh,
the
really?
expense, yes, because we're getting the tax credit and then we're not allowed to depreciate, yeah.
I thought this was a commercial example.
So for a commercial, yeah, so in a commercial example, I don't know if the IRS would allow you to depreciate it, but certainly if they did allow you to depreciate it, that would be a consideration, because one of my slides, if I go back several slides, I did say everything should be considered from an after-tax perspective.
Okay.
Where was that slide? So, yeah, so there is a tax perspective that you have to consider, but if it's a residential investment, then you're not allowed to depreciate. Okay, so now let's incorporate inflation. We'll put off interest cost and the other aspect for a moment. Let's just look at inflation. How would things change? Well, things change for the better in this case. Surprise. So inflation helps certain things and doesn't help certain other things.
Is that because the cost of the electricity goes up?
Exactly.
Okay.
Yeah, so more savings.
That's exactly it. So if you look at the savings under the total column, the savings start off at 2,662. I'm assuming the inflation rate is running at 5% per year, but looks like it's going to be closer to 8%. In that case, it only helps our case because now our savings are higher year after year, so that in year 10, because of inflation, we're saving 4,130 from this installation versus 2,662 in a zero inflation environment. So now how do you calculate the payback? The mechanics of calculating the payback become a little bit more complicated. So I have an additional column called the cumulative cash flow. To calculate the payback, you simply cumulate the cash flows every year until you hit that point where the cumulative cash flow is exactly equal to zero. Okay, so for us, that happens somewhere between the 6th and the 7th year. So let us say it's 6.5 years. So earlier our payback was 8 years. Now with inflation, our payback is 6.5 years. Okay? That still doesn't answer our question. What should be the benchmark for the payback? Should it be 2 years, 3 years? If it was 6 years, is that such a bad thing? Well, the payback suffers from that limitation. So what we really need to do is to calculate a return on our investment. If we calculate our return on our investment, then we can compare it to what the interest cost is from the bank, right? Now the interest from the bank is not the complete story, because what if the bank doesn't pony up the entire 28,000? What if they only pony up 10,000? And then you have to bring some of your own savings to pay for this initial investment. How should we think about the cost of our savings? Is our savings, do they have a zero cost or do they have an actual cost?
It's an opportunity cost.
Exactly. So here's where opportunity cost comes into play. There's an opportunity cost associated with our savings. So we cannot think of savings as being zero cost. What is the opportunity cost of our savings? Well, we could be investing it in crypto, we could be investing somewhere else, and we could be earning a lot of return from that. More likely than not, we have taken our savings and we have invested it wisely in the stock market. And we've been able to generate a return over a historical 70-80 period. The stock market has generated a return of somewhere around 8% a year. So that's the opportunity cost of our savings. And in fact, our savings cost much more than a bank loan, right? So those two things, if you put them together, that gives us a cost of capital, and we would compare the return on our investment against the cost of capital. If the return on our investment is bigger than our cost of capital, then we would say this is an excellent investment because we're able to generate much more from here than by investing 28,600 somewhere else. On the other hand, if the return on our investment is lower than our cost of capital, then we would say, no, we should reject this project. So now we have a very objective measure of whether or not this is a good investment. Simply calculate what is the return on our investment and compare that to the cost of capital. So now you don't need a rule of thumb. You don't need to rely on some arbitrary benchmark for the payback period. You can right away see if this is a good investment or not. Now, the mechanics of calculating a return on investment for a multi-year project is a little bit complicated, but there is a word for it. It's called the internal rate of return. It is the rate of return on an annualized basis that is generated by this project. Okay? And you can feed these cash flows into Excel and have Excel spit out the IRR. It turns out with the inflation at 5%, this project has an IRR of about 8.5%. So when you compare the 8.5% against the cost of the loan from the bank, I'm calling it a personal loan because that's what the banks offer now for financing such a thing, like a solar power installation, you have to take out a personal loan. And the personal loan rate right now is 6.74% APR for a 3-year loan. So that's an expensive loan. And the project is generating 8.5%. So it's not a bad investment. So inflation is actually going to help us because it makes the project worthwhile, because the savings that we're able to generate are substantial, especially later on during the life of the project. This is something that the payback also misses, that it ignores all the cash flows beyond the payback period. So let us say that the payback is 2 or 3 years, is what somebody has as the cutoff, and this project is paying off after 6.5 years. People might be tempted to say, oh, we don't like this project. But what that ignores is that there may be a substantial sum of substantial amount of cash flows that are coming in years 8, 9, 10, and beyond that are being ignored completely by the payback. So there are other ways of figuring out whether this is a good investment. We've talked about 2, the payback period and the internal rate of return. And for the others, we would have to go through another seminar. So thank you for listening to me.